Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meisinger. I welcome you back to another ISE webinar. Today, I'm pleased that I have Patrick Ceresna with us. Patrick is with OptionSource.net, and his partner, Jason Ayers, just delivered a great presentation on FX options using technical analysis to trade FX options. Patrick will be talking about, well, the topic of his presentation is beyond buy and hold, option strategies for the diversified ETF investor. This is going to be a great presentation. I'm really happy that you're all here today, and it's just going to be fabulous. Learning a little bit more about diversification, the different asset classes, and how we can reduce some of the correlation risk. Patrick will be talking about some of those subjects. I want to remind everyone that options aren't for everyone, and you really should understand as much as you can about options. So one place you might go is OptionSource.net, where they have a free class tomorrow and Thursday. Go to OptionSource.net. If you want to learn a lot about options, we at the OIC, the Options Industry Council, offer many free classes. There's a lot of classes online. We have webcasts, we have live events. I'm typically a presenter at many of those live events, so please check us out. You should get a copy of the characteristics and risks of standardized options. Please do that before you trade. And just remember that taxes, margin, and commission are not included in any of the examples today. Very important factors. And today we're just talking about these examples should be used, or they will be used as illustrative purposes only. So remember, we're not making any endorsements to trade. Without further ado, I want to introduce Patrick Ceresna. Again, he and Jason Ayers are OptionSource.net, and they help educate investors in the use of options, portfolios. So please go to their website, OptionSource.net, and enjoy the presentation. Patrick, how are you?
I'm very good, very good. How you doing, Steve?
I'm doing great. Take it away.
Great. Hello, everyone, and thanks for joining us. Steve, was there anything else you needed, or can I get things underway here?
Yes, you're good to go, Patrick. Thanks again for joining us. Really appreciate it.
Thank you very much, and hello, everyone. And I just wanted to thank Steve Meisinger for having us on, and we always enjoy when we meet up once or twice a year. We always end up crossing paths at one of the shows, and it's always a pleasure hearing back from you. And hello, everyone. So today we wanted to cover on the topic beyond buy and hold for the diversified ETF investor, and how to actually use some different option strategies within the process. And really within 1 hour, we can only really scratch the surface of the many different strategies that can actually be utilized throughout the process of investing. So really the whole purpose of this is to give you guys some very simple, clean strategies that really give you guys so many different ways that you could look at your investments. Now, the first thing I always want to start off with is talking about modern portfolio theory. Just one quick little slide on that. And the reason I would touch on that is because the ETFs exist because of modern portfolio theory. For about 2 generations, there's been the MPT created models to maximize risk-adjusted returns, and that's where the diversification really came to truly its existence. And that created indexing, benchmarking, and the attempt to remove specific risk through and only be exposed to a systematic risk of the broader markets. And this is when you trade ETFs, whether you know it or not, you're subscribing to modern portfolio theory because you're choosing to apply a diversified approach to trading a particular sector or a particular asset class without or a commodity or whichever.
Checking the sound, making sure the sound is working. Can everybody hear me? This is the host, Steve Meisinger. Can you guys hear me? Just type a double Y. That way I know that YY means that you can hear me. Okay, great. Unfortunately, for whatever reason, we've lost Patrick. So that's peculiar. Patrick, are you there? I'm going to... It sounds like everybody can hear me, which is good, but most importantly, you need to hear Patrick. Patrick was about to describe portfolio theory. In fact, he got into it a little bit on diversification, efficient portfolios, and we need for Patrick to call back in. Problem on my end. Don't know, John. Oh, Patrick, are you there?
All right. Hello. Yeah, I'm back. So.
Oops. Looks like Patrick is there, and now he's not.
Steve, can you hear me?
Yes.
Hello.
Gotcha, Patrick. You all right?
All right, I'm okay. I don't understand why the phone cut out here, but I'm back. But anyway, okay. So can we carry on here? All right. So sorry about that, everyone, but we're back here. So the key thing that I wanted to carry on from there is that when the process of creating these ETFs. By the way, can anyone just let me know that the sound is back, and just if you guys can type it in that the audio is coming through, so I just know I can carry on. I'd appreciate that.
You're good, Patrick.
All right, thank you. So, the shortcoming though of diversification in the end is it dilutes returns. So even though we dilute risk throughout the process of investing, we actually subsequently also dilute returns. And this means that on average, people will create only modest returns through holding a fully diversified portfolio. And this is where we want to learn different techniques for how to actually profit from the markets and how to actually optimize their returns using some different option strategies. And one of the things that when you incorporate options into your portfolio, you can utilize options for income. You could use options for as protection. You can use it as an alternative to actually owning the ETF. And you could also create what are called like option collars. And I wanted to cover each one of those strategies in a little bit of detail. Obviously, within an hour, I'm not going to be able to delve into the intricacies of the process. But the real purpose here is to give you guys all some ideas of what it is that's available for you out there that you can incorporate into your ETF portfolios. Now, the first thing I want to talk about is the idea of covered call writing. And when we actually own an ETF and sell a covered call against it, or a call, and that's covered by the stock, it's the idea of you collect a certain amount of premium up front for having given up the upside potential of a particular asset beyond the strike price. And I always like that saying, a bird in hand is worth two in the bush. The question is, would you take right now a certain amount of return that you know you will get versus the potential return you could have if you were right, but if you're not right, you don't make anything. So and the covered call writing represents this very thing. Now, what happens is that when is an ideal time to incorporate covered calls into an ETF portfolio is really the way I look at it is at two stages. When the exchange traded fund that you own is relatively range bound and not trending. So that means that the ETF is actually not moving. So you might as well make some money while it works itself out, that sector or asset class. The alternative also is that when you, let's say, caught a very nice rally in let's say an ETF, and there's signs that it's reversing or topping out, it always represents a reasonable period of time to consider actually selling a covered call and generating some income on that. So I'll give you guys an example of that. First of all, just for those of you, I have to assume that many of you may be brand new to options, so bear with me while I just do a very quick summary. But in order to do a covered call, you actually have to own the ETF first. So when we own that ETF, when we sell the call, we get paid an upfront premium or an upfront amount of money for giving a right for a speculator to buy that ETF from us. And now that speculator that's buying the call option and we're selling it to them has the right to buy those that ETF off of us at a specific price over a specific period of time. The best way to demonstrate this, obviously, is by actually looking at a real example. And that's the way most of us learn the best. So what I did here is I have an example of the ISC natural gas. This ETF, which is created by the First Trust in Corporation with ISC, is based off of the ISC Natural Gas Index, which I do some analytics on a weekly basis. So we post it on their sites there. But this is the actual ETF of that, and you can see here that this ETF has more or less been rallying up from about $15 to $21. Now, I wanted to illustrate an example. Let's just say where that little dot is in the middle of the graph out in November, it was trading around $18. And let's just say you purchased this ETF at $18 back then. And now over the subsequent 2 months, so you originally bought it back in November at $18. Let's say you bought 500 shares. And so you paid $9,000 for that ETF position, and let's say it rallies up to $21 over the subsequent couple of months. So now here we are in February, and the ETF's at $21, and you're sitting on $1,500 profit, a very nice $3 per share. And now you like your ETF, and I mean you're holding your diversified portfolio. You're not really this market timer where you're always going in and out. You're just holding a portfolio of great ETFs. But you realize that much of the upside potential has already been made in this ETF. And so you look right now and you get a quote, and you see that the ISC is showing on that June $21 strike. So it should say call. My apologies. You see how it says put there? I apologize for the typo. The call is a $1.20 bid. And so what happens here is we sell 5 covered calls at the bid. So if we sell 5 calls at the bid price of $1.20, we receive $600 cash flow premium for giving somebody over the next 4 months out till June the right to buy this ETF from us at $21. So we made an additional $1.20 income for obligating ourselves to sell it at a profit, which we've already made the profit from 18 till 21. But we're now saying it could go to from 21 to 22 or 23. But at some point when it pulls back, you'll be back at $21 or less. So if I have the chance to make, if we can now have a chance to make that additional $1.20 of cash flow up front, why not take it, right? And that represents basically a 6% cash flow over 4 months. So that, most people would say, hey, you know what? If I can make a 6% cash flow, that's a pretty nice little bonus dividend on top of that, selling that ETF at that higher price. And so incorporating covered calls with an ETF that's been doing well for you, once it reaches a price level where you're happy with the returns that you're getting, and you subsequently can profit from it that way. So now what I like to kind of put it in perspective here is that over the next 3-4 months, that, let's say, ETF could have traded to any of these prices. That ETF could have kept going up to $22. It could have gone to $23. It could have dropped down to $20 or even broke down to $19. But now look at this perspective. And now you cut off the upside because you gave the upside to the speculator. So basically, if we just own the ETF at 21 and rally to 23, we would be up almost like 10% on our ETF over the next 3-4 months. While but in this situation, because the speculator was speculating on the upside there, we only made 6%, and the speculator made the upside potential because they had the right to buy us from us at 21. And no matter, notice here that we basically got the same return with any price above $21. It could have gone to 25, 29, doesn't matter. We've made 6%. But that 6% cash flow that we made, that $600, represents a real return that cannot be taken away from us. That's a very powerful. But now also notice here that let's say that ETF finally did a little profit taking and it dropped back to $20. Because we collected a $1.20 income and the ETF dropped $1, we actually have reduced our cost base by $1.20, and therefore we actually still remain profitable on the position. And under the circumstances, let's say the ETF pulls all the way back to $19 over that sequence. Well, in that scenario, we're down 4%, but we're not down 10% like the person that would have had the ETF at 21. See, because we got to keep the $1.20 income. So what happens is that at some juncture, when you own one of these ETFs, let's say you have 5, 6, 7, 8 ETFs in your diversified portfolio, eventually as some of these rally to levels that are very acceptable on the upside in terms of how far you anticipated them to go, at some point the risk reward of not taking the call premium and hedging the downside risk versus trying to make sure you leave upside potential, at some point the risk reward proposition favors just selling the cover call and taking that bird in hand worth 2 in the bush kind of scenario. And taking that premium and actually saying that that's good enough for me to get an extra 6%. And what's nice is that if the ETFs are, let's say you're buying an ETF that pays dividends or distributes dividends that are collected within there, you'll see that you'll receive those dividends in addition to this call premium. Because ETFs and more often than not are American-style exercise, which are different than index options and currency options, but most of them are American-style exercise, which means theoretically there's always the chance that we may get exercised on the ex-dividend date. So you're not guaranteed the dividend, but I would say more often than not you will receive the dividend. In that equation, the option always has the possibility of an early exercise. Now, the next thing I wanted to cover here, I would just always like to make that statement in the book Long-Term Investment Alternatives for Fiduciaries by Dr. Sheen Kassoff. They basically make a statement that over a 10-year period, if the compounded return of stocks is 14% or less over the long term, a covered call strategy would not only reduce your volatility, but increase one's return. And that's really what I was trying to point out there is that, look, if that ETF has already rallied and has made some good money, at some point, taking an additional premium from that and hedging downside risk while guaranteeing yourself a certain type of return actually gives you overall a much higher performance. Now imagine just for a second that net at the end of the year, after holding all your ETFs, if you were able to just simply create an additional premium of even 5% over the course of a year. Well, in most part, and especially during the bullish parts, you don't have any covered calls written. But if you can just enhance every year your annualized rate of return by 5%, you actually are going to far exceed the performance of the market. In fact, in the very big picture, if you go back even a century or more, the stock market has on average returned in the vicinity of about 6% annualized if you go back. And obviously, if you measure something like the 90s, it looks like it was a 10+%. And if you measure the last decade from 2000 to 2010, there were no average returns. In fact, it might have even been negative. And so but when we go long term, if you think about it, stocks in the bigger picture really only average about 6% over the very long term. So if we can just create 5 or 6% return off of covered call writing, we actually are going to outperform the market in almost all scenarios. Now, and now the other strategies which you can utilize covered call writing on are things like establishing a price target. For instance, let's just say with that natural gas ETF, we were looking for a $22 target. So it's at 21 now. We've already up $3. We could always sell a covered call out at the $22 strike. And now what we've done is we've locked in our sale price at 22. If it rallies up to there, that's where we're going to be obligated to sell. But we at least collected a premium. If it never gets up to 22, at least we made some money while that goes in there. Now, the question online here from Tony is, how about selling calls below the price? And that's called, that's actually the fourth point down. It's called hedging individual stocks. So I'll get to that one in 1 second here, Tony. But generating income off of long-term holdings, if you intend on owning these ETFs, but you notice that they follow, this ETF follows a channel, whether an upward rising channel or a sideways channel, and you relatively can identify when the market rallies to the top end of the channel and before it pulls back to the bottom of the channel. Every time it's at the top end of a channel, if you sell a covered call and up at the higher strikes, you just collect a few percent, at least what happens is that you may have no intention of wanting to sell this, but you can at least generate a little bit of additional return. And it's funny how it works, but most people don't realize that the difference between if over, let's say we took $100,000, and if the average return of your ETF portfolio is only 6% a year, that $100,000 portfolio would only have compounded to about $400,000 over 25 years. But if all you did was found a way to create a 10% rate of return on your ETF portfolio versus 6%, by just increasing your return by 4%, that same $100,000 would have compounded to well over $1 million over that same 25 years. Few percent higher creates an exponentially larger factor. So in fact, when you're running an ETF portfolio, it's not about finding always how to make a 20-30% return, but it's just about, in an efficient portfolio, you're just trying to find a way of creating alpha, a way of creating an additional return that just enhances your net profit in the big picture. The third point down is repairing loss. And this is a very viable strategy that when an ETF goes down, let's just say we have a strong U.S. dollar rally and agricultural stocks and all these commodity stocks start going through a profit-taking cycle, and suddenly there's a very dramatic one-day drop. Let's say you're trading the ISE copper ETF, and with a strong U.S. dollar rally, suddenly copper finally goes through a profit-taking cycle. If it suddenly had a big gap down and it's going down, well, in the bigger picture, you probably would be fine owning copper, but you're going to go through a short-term profit-taking cycle. Well, every time you sell a covered call against that position, you keep bringing your average cost base lower. And as you're bringing your average cost base lower, you're bringing your break even lower, or the point where you start becoming profitable again to a lower starting point. And so you can, by just offsetting the downside with by collecting some premium, is a certainly good way of trying to repair your loss. The fourth one down, hedging individual stocks. Is the idea, just like Tony was asking there, about writing an in-the-money covered call. If let's just say we rallied that natural gas ETF from $18 to 21, like in that example, we could have actually sold an in-the-money $20 call. For those of you not familiar with options, by selling the $20 call, you're locking in the sale price at 20. And most people would say, well, why would I agree to sell my stock at 20 when I could sell it right now for 21? Well, what you have to realize is the way option prices work, and that the intrinsic value of every option is reflected in there. So you might, let's say, get a $1.60 premium for that, and $1 of it represents the fact that you're selling it at an in-the-money strike down at the $20. If you did that, and you, let's say, collected $1.60, you could actually weather a pullback, let's say, down to $19.40 from 21, and actually have never experienced any loss because the premium you collected for the in-the-money call actually hedged all the downside risk associated with the short-term pullback. This is always a good strategy when you're just thinking that the market will have a profit-taking cycle, not a bear market crash. The thing is, if you actually are bearish and you think the market may go down significantly, at that juncture, you must adapt a strategy that is more oriented to sector rotation, and particularly asset class rotation. You might at that point go into a lot more bond ETFs and other things like that. The other thing that you could always do in the same hedging strategy like we just talked about, if you sell that covered call in the money over a tax period, let's say you did it in November and you did it for a January expiration, more often than not, the covered call will get exercised in January, which means your actual tax disposition occurs in the next tax year and not in this tax year. But yet, by doing the covered call, you actually hedge the immediate downside risk. So a lot of times, if you know that you want to sell something, but your only reason you're not selling is because you want to wait till the new tax year to actually sell it, you could always do an in-the-money covered call. And more often than not, and I don't want to say it's guaranteed, because you want to understand that when you do an American-style option, there's always the risk that there could be an early exercise. And so therefore, you never want to make anything sound absolute on that front. But I would say more often than not, you're going to get exercised in the next tax year. So that's just some ideas for how to cover call right.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.